Hello, good evening, ladies and gentlemen. I hope you can hear me. We start this session on rupee forecasting. Thank you for coming in and sparing this time. As the Chinese say, when they have special love for somebody, they say, may you live in interesting times. So we are definitely living in interesting times. But as other people have said, tough times don't last, tough people do, and even this shall pass. Today, what I'm going to share with you is the forecasting process that we have at KSHITIJ, where we look at more than 50 variables when we are forecasting rupee, maybe close to 60 variables, if not more. And we look at most things from the prism of charts. And within charts, we look at many different time frames that would daily, 3-day, weekly, 13-day, monthly, bi-monthly, quarterly, yearly. I'll show all that to you. We also look at very long histories, as much as we can get, maybe even up to 150 years or more. And we also look at fundamental data. I'll share that also with you. Having as part of the process, we do all this and then we put it all together. And having done that is when we can look at the rupee charts. Thereafter, we examine our own errors, and over time, we try to improve it iteratively. And over the last 14 years, our reliability stands at 60% as per one criteria, and at 73% as per another measure. So the first thing is the factors that we look at. Here is a snapshot of the different factors that we look at. We look at the currency markets, we look at equities, commodities, bonds, and at India's balance of payments. Within each market, we may look at correlations and at intermarket relationship, right? So within currencies, just for example, we would look at emerging market currencies, the dollar index, the euro, Chinese yuan, etc., etc. Equities, we would look at Dow Jones, Nifty log, etc. Commodities, we'd look at gold. Bonds, we'd look at European yields, US yields, Indian yields, etc. And a lot of intermarket, a lot of correlations and a lot of intermarket relationships. Okay. So I'll take you straight away into something that we were looking at today. As a starting point, we usually look at, say, the gold charts, because gold is a kind of a barometer for risk on, risk off. So we would start with that. And here is an example of the different charts that we have. This is a daily chart and a 3-day candle, weekly candles, going on to a 13-day chart, monthly chart, bi-monthly chart, quarterly charts, and even yearly charts over a very, very long history. So here we have a chart which goes back to 1836. Having examined, and this we were examining gold just yesterday, day before yesterday, and we said whenever we look at it, we take a look at what we said earlier, and then we do so we always do a recap of whatever we were looking at earlier, and then we come on to what's our current reading. And so we say we now look for a range of 1750 to 1650 or 1620 till mid-May or end May. And then depending on whether the market closes near 1750 or 1650, it will either take gold up towards 1800 or down towards 1550. While above 1500, we have to acknowledge that the path of least resistance continues to point to the upside. That said, a rise past 1800 is needed to take the market up to 1900. So where do we see 1800? We see 1800 out here on this horizontal resistance coming from 2012. Having looked at these normal charts, we here have this quarterly candle chart coming from 1998, but this does not satisfy us. So we also look at a chart here, as I said, we generally also look at a lot of very, very long history we look at. And here we have history of gold since 1836. As I said, we look at very long histories. Why do we look at long histories? In order to try and make sense of the current period within the historical context. Also, why do we look at, say, a quarterly chart? Why do we look at a monthly chart? Because most of our clients are importers and exporters whose payables and receivables fall due over the next month, 2 months, 3 months, or even 6 months. So we have to, when we are trying to forecast for periods up to 3 months or 6 months or even up to 1 year, looking at just daily charts or weekly charts is not enough. We have to always try and keep the big picture in mind. And within that, we got to look at the smaller picture. So here, coming to this chart, here we have that gold went up to $42 an ounce during the US Civil War. Then it came down to $21 and it was at $21 while the US was on the gold standard till all this time. And in 1971 is when the US broke from the gold standard. This is a log chart. We also use log charts a lot because that helps to make sense of very large movements in price. Otherwise, normal price charts, nominal charts, we would not be able to make sense of the movement over time. So we use log charts also. So this is a log chart. As you can see, this we've marked out $42 out here, but on the axis you can't see 42 because these are log values of the price. So we were at 42 here, and then in 1971 gold was at $35 when the US broke away from the gold standard. Then gold rose to $612 in 1979-80 when there was a Soviet invasion of Afghanistan. Sorry. It fell to $272 in 2001 when the Bank of England sold gold, and then it rose to a high of 1921 in 2011. So we are assuming, now here we bring in another technique of charting called the Elliott waves, where we see that this movement, so here coming back to this chart, we have what we interpret this as a five-wave movement: 1, 2, 3, 4, and 5. If this be true, then we could be looking at an A, B, and C correction, which could bring us down to $992 over a period of time. Now, these are yearly charts. Each point here is 1 year. So there are views out here that, I mean, in the market, the general consensus is that gold is headed much higher. But when we look at history, we find that there could be chances gold comes lower. Now, whenever we look at something, we don't look at that thing alone. Here is that we would cross-examine gold with the euro. So when we look at gold across in euro terms, we find that there's a resistance out here, and there could be chances of gold coming down in euro terms. Then we find that the gold and Dow ratio also has a resistance out here. Gold has risen tremendously against the Dow, but right now here it is finding a resistance and to come down a little bit. And I will share a very, very important chart with you, which is the gold Brent ratio chart since 1860. So we are at a place where gold is at very strong and crude is at very low levels. But when we look at the gold Brent ratio, we find that it is at a resistance line again out here. So Again, this is an yearly average, so what I'm going to say would not necessarily hold absolutely in total, but it gives us a sense that gold is extremely overvalued as compared to crude. So if there was a person who had cash, that person might want to think about buying crude rather than gold. So this is part of the process. As I said, we look at gold by itself, and then we look at gold in relation to the euro, in relation to the Dow Jones, in relation to crude, so that we get an idea of relative uh, valuation of gold vis-a-vis other markets, because markets move on movement of capital at the margin. Okay, so this gives us an idea that gold could possibly be coming down. Having looked at this, then we look at another measure of uh, global risk off, which is the risk off, which is the US Treasuries. And within that, I'll share another very important chart with you. Is this chart which is juxtaposition of the gold, which is the blue line, and the US 10-year Treasury bond yields, which is the pink line, on a reverse scale. And we find that the two have been moving very close to each other in a highly correlated manner since 2005. And this suggests to us, and which is basically a very strong indication of risk on risk off. So whenever people are buying gold, people are also buying treasuries, and that's why treasuries are so yields are so low. So this warns us that in case gold happens to come off, then treasuries could also treasury yields could also bounce a little bit. And here I'll bring you now to another part of the process, forecasting process that we have, that when we look at the treasury, when we examine treasuries, we again look at various things that go up to make our treasury analysis. So we would look at the USIIP, capacity utilization, etc., housing starts, okay, consumer confidence, etc. We look at all of that, and we look at the US Treasury charts. So I'll show you the US Treasury chart first, and then I'll take you to an important thing that we look at in terms of fundamentals. Here we have the yield charts that we'll look at, and on the 5-year chart, we find that there is a case for the movement from October 2018. This is a reverse scale. So the fall in US 5-year from 3% to 0.35% now could be a 5-wave up move. And if that be so, then there could be chances of the 5-year yield moving up to 0.75% roughly before it again goes down. Why I showed you this was earlier I shared with you that we had this chart. We were looking at gold and treasury together. When we look at gold and treasury together, and we find that gold could possibly be coming down from between, or be range between 1700 and 1650. Gold gives us a clue to treasury, and when we examine treasury, we find yes that there is some chance of treasury yields moving up. And within the study of the treasuries, I want to share with you that we look at fundamentals. So here is an example of the US consumer confidence data. This is a projection of the data that we have made for up till June, and thereafter also we would assume that the consumer confidence in USA could keep coming down to levels of say 70% or even lower. So we could even see, say, over the next uh, another 3-4 months, we could see data, I mean the US data keeping on deteriorating. Now I will bring you to what we said in our April report. This is our April quarterly forecast. I hope most of you and all of you would have got this. Here we said that this was published on 6th of April, and we said that we reckon that the markets are currently pricing in about 6 months of economic disruption in the USA, including about 7 to 8% unemployment. So that's an example of what I showed you, that some people think that we would be looking only at technicals, while yes, we do place a lot of weightage on technicals. We also look at fundamental data, and we are not in the argument of, we would not like to get into the argument of this versus that. We would always like to work with this and that. So we would like to work with technicals and with fundamentals. So because we've got this data, we can figure out that yes, this chart is going to come down. So when this chart keeps on coming down, we know that this is already part of this is already priced in. So we'll not keep getting surprised by this. Having come to our April report, I'll show you this chart. This is a chart of the Dow Jones since January 1900. Again, this is a log chart, and here we were looking at this blue broken line, which we call a fault line, and we said that this fault line has been tested and possibly there can be chances of the Dow bouncing from here, because if it doesn't bounce, then maybe we could be looking at uh, a repeat of something like 1929, 1932, but the chances of that are lower. As we said, I'll show that to you, because the difference is that while in 1929 there was no rescue package at all, and in 2008 the Fed came up with the QE, etc. After some months, this time around, rescue packages are lined up immediately. Plus, in terms of scientific and medical advancement, 2020 is way ahead of 1929, 1932. There is a chance, therefore, that 18,213, 150 could hold as support. Or now it is a wait and watch. Now I show you to share with you what the thing looks like currently. So here is the chart, is the same chart which has now bounced from the earlier it was when we had done this. Dow was at 21,053, and now it has bounced to 23,018. Okay, so even if there is another fall from here, in case things go bad, further bad, and lockdowns are extended, or there's a second wave, etc., etc., there could be chances that this fault line, okay, will hold. Even if that fault line doesn't hold, there could be chances that this line, this support trend line, could hold. And if that happens, we could be spared the agony of going down to the 2008 lows, or the agony of something like the Great Depression. This is what the price chart tells us, the long-term price chart. Again, in the April report, we had shared our COVID chart, which a lot of you would be familiar with. We've been sharing this regularly. So that time we were looking at 18,000 cases by 14th of April and 2,19,000 cases by end of April. But now there are very real chances that we might have only about 55,000 cases, and in this we had also shared a long-term quarterly log chart of the Sensex. So I'll share that with you. So here we had said that there was a multi-year consolidation, and there was again this blue support trend line, testing support, trend support since 1988. So I'll share the current position from there. This is the same chart with current prices. If you can see, I will make this a little bigger for you. You can see that this candle, which is a quarterly candle, has bounced up a little bit. If you see that on the nominal chart, you find that the quarterly candle has moved up. So the support is holding. The low that we had seen of 25,638 in March, from there we bounced. So now we have supports at 28,000 and then 35,600 on the Sensex. Corresponding figures can be seen on the Nifty. Now, going forward, we could see, we may or may not see a second leg down to here, or whether we will see consolidation like this and move up here is what we are trying to examine, which is we are in the process of doing that, and I hope that we will be able to share our next long-term forecast with you within the first week of May. Again, coming to our April forecast, after having, I mean, here we had featured the Dow Jones, the COVID chart, we had looked at the US debt spread, and we had also looked at the currency markets. Within that, we had looked at, say, the dollar index, the euro, uh, the Asian currency index, and the Chinese yuan, and the ratio between the Asian currency index and the rupee. So largely, if I were to, classify the factors which impact the rupee, it is the currency markets, the equity markets, the commodity markets, and the bond markets. So we try and these are the four markets from which the demand or supply for rupee for the dollar keeps coming in or going up. Coming back to our April forecast, we had also examined the balance of payments for India on a quarterly basis, and we had said that there could be chances of the current account actually going into a surplus. So here we have, for this portion is our projection, so that we could have a surplus for 2020, for the financial year 2021, and especially the first two quarters could see a surplus on the current account, and even if thereafter things become normal, even if there is a deficit, the current account deficit would be very nominal, largely because of the decline in crude. And if things do turn out, if we don't have a second wave of infections or something like that, then there could be chances, as I shared, of the on the Sensex of the Indian stock market moving up. So if that happens, then we could have the current the capital account also being positive, which is the green bars. So here we have that the balance of payment tells us that there can be chances of having a positive balance of payment, and or more importantly, we generally have a positive balance of payment, but more importantly, we can have a positive current account position. So these are some of the factors that we look at while making our rupee forecast. Now coming back to where I started from, this I have tried to cover this portion, that there are so many different things that we look at, and we look at fundamental data also. Then we put it all together. So here is, this is currently work that is going on for the May forecast. And here I'm now coming back to the process, that those 50-60 factors. Here today we have looked at the gold charts. So here is our reading on gold. Okay, we will be looking at we will be doing detailed study of the Dow Jones, the Sensex correlation with Dow Jones, the rupee correlation with Dow Jones, and then Brent. We've just finished our Brent study, which has been shared with all of you today. So what is Brent looking like? All of these things we look at, and what we do is that for each factor we put in, we give it a numerical marks between -10 and +10. So -10 means absolutely negative for the rupee, and +10 means absolutely positive for the rupee. So between -10 and +10, we give a marks for each reading that we have. So here, for instance, for the gold, last month we had a reading of -5, and now we give it a +1. So there's a small, the reading on the gold would go from having a negative impact on rupee to having a very mild positive impact, which is not very significant. This is how we give marks, and these are then aggregated out here. So look at the April figure. So all the sorry, let me first show you this again. All these are summed out here. Say you can see -24. This is as of based on April figures. Okay, and that comes here. April was -34, and there were 18 factors which were positive for the rupee, 19 factors which were negative for the rupee, and this is then the marks are then charted along with the rupee, and this actually works as a contrarian indicator for us. So where we find that the marks are very negative, then we have seen that generally the rupee tends to appreciate after that, and if the marks are very positive, then the rupee actually tends to appreciate after that. Sorry, depreciate after that. So we aggregate all of this together in this manner to give us feel of the overall market conditions for rupee, and then we go and start looking at the rupee charts. After having looked at the rupee chart, we also examine our own errors and we try and improve iteratively. And I will share with you our current forecast statistics. So we measure our reliability based on two criteria. One is whether a forecast has been directionally correct or not, and secondly, whether what is the percentage error of the forecast, and both of them put together, we figure out whether a forecast is either bad, which is -1, or good, which is +1, or 0, which is just okay. So we have been tracking our error since 2006, so that's about for the last 14 years. Earlier, we had one criteria based on which our reliability would currently stand at 79%. So this we found was very lax. Then we devised another more stringent criteria based on which our reliability stands at 73%. And this one, the red one, is the newest, or you can call it actually the oldest criteria, which takes into consideration only directional reliability. So that stands at 60% just now. So this is like kind of our career batting average. Coming to the euro, sorry, on the daily we find that this downtrend since 1.15 is still there, but we also have support at 1.0650, and the way this chart is shaping up right now, euro looks to be kind of ranged between, okay, this is the range that we possibly look at for euro. The price action suggests that the market is ranged, which is also what we see on the weekly candles. We've had a lot of ups and downs, so both bulls and bears would have got rogered, and that is a very good case for the market going into a range rather than going in for a trend, which is something that let us see what it looks like on the line charts. The line charts here are not giving us the 13-day chart here tells us yes, the overall downtrend is still there. So also on the monthly candles, but on monthly candles we have that there could also be support in the around here on this blue trend line, which gives us a 1.06. On the bi-monthly charts, we have that there is support on euro coming up from 2000. Okay, so this suggests that there should be a floor for the euro, with something that we see on the quarterly candles also, and we see on the 13-day line charts. So we would have support here if this support holds, but we'll have to move above. If the support holds, then the euro could go up towards 1.15 like this. But for that to happen, we would need it to rise past 1.10. So whether that is happening or not is the question to ask. For the very near term, I mean, and in case it is unable to rise past 1.10, then there would be a further euro to fall. So that is where we are standing on euro at the moment. I don't have a definite answer to that at the moment. We would look for a rise above 1.10 or not. We got to see how it goes. I think the market can be raised for at least the next couple of weeks, maybe into May, and then let's see what happens. This I showed you was how we examine the charts and euro, and then we'll look at the next step for us would be to look at what happens in euro rupee and then the correlation between euro and rupee. Again, I say thank you very, very much to all of you for being here. Thank you so much.